In 2025, the rules of money are changing, not in headlines or government reports, but quietly, inside private meetings, exclusive clubs, and investment offices most people will never see. The people who already have everything are rethinking everything. For decades, the wealthy played by one simple formula: buy property, hold stocks, trust the markets, and let compounding do its magic. But the data shows something different this year. The world's rich are no longer just buying mansions and stocks, they're rewriting the playbook, and the way they're doing it might surprise you. According to Forbes research, 71% of high net worth individuals say they're still expanding their real estate portfolios, but that number used to be 87% just 1 year ago. That's a steep drop, 16% of the wealthy backing off in 12 months. On the surface, it's a small change, but beneath it, it's the biggest mindset shift in decades. Because when the people with the most money in the world start changing what they believe about wealth, the rest of us should probably pay attention. For generations, property was the safest bet in the world. You could feel it, walk inside it, rent it, pass it down. It symbolized success, stability, and a permanent place in the hierarchy. But now, even the ultra-rich, the people with more than $30 million in liquid assets, are questioning that foundation. Forbes found that only 31% of them still fully believe that diversifying with high-end properties is the key to long-term financial success. Among those who are just regular rich with 2 to 5 million in assets, that belief drops to 8%. The wealthy are cooling on real estate, and that single fact marks a quiet turning point in modern wealth. Behind this shift are three words that keep investors awake at night: inflation, instability, and interest rates. Rising inflation eats at savings. Geopolitical instability turns global markets into unpredictable storms, and higher interest rates squeeze returns on everything from mortgages to bonds. In a world like that, property isn't the fortress it once was. It's expensive to buy, costly to maintain, and no longer guarantees appreciation. Even worse, it ties your wealth to a single market, and when that market crashes, so does your fortune. So what do you do when the foundation of wealth starts to crack? The answer for many high net worth individuals is to build a new one, a quieter one made not of real estate or stocks, but of alternatives, the kinds of assets that don't move with the market, can't be printed, and can't vanish overnight on a stock chart. According to a report by Gordon PwC, the traditional 60-40 portfolio, 60% stocks, 40% bonds, is dying. In 2025, the rich are replacing it with something radically different. Up to 20% of their portfolios are now allocated to alternative investments. Historically, that number was 3 to 5%. Tripling or even quadrupling exposure to alternatives isn't a tweak, it's a revolution. But what exactly are they buying? The answers range from the predictable, like gold, to the unconventional, like tequila barrels and fine art. These assets share a single trait: they're tangible, finite, and disconnected from the stock market. They offer not just profits, but control. Start with the backdrop: inflation that refuses to back down. It erodes the value of money sitting in banks and bonds. For the rich, who often have millions parked in cash-like instruments, inflation is a direct tax on their wealth. Geopolitical conflicts, from Ukraine to the Middle East, destabilize global supply chains, spark energy shocks, and rattle investor confidence. And the central bank's answer to all this, higher interest rates, makes traditional borrowing and investing more expensive. The result? Even the rich feel cornered. So they've begun looking for shelter in a different kind of storm. Tequila casks are the most surprising of these new safe havens. It sounds like a gimmick until you look at the numbers. Premium and aged tequila has exploded in demand worldwide, rivaling whiskey in both taste and collectability. The tequila market is projected to grow by 11% annually through 2032, hitting $42.5 billion in global value. For investors who buy entire casks, the projected returns hover around 13 to 15% per year. That's more than most index funds, with the added bonus of holding something real, aging, and appreciating with time. Scarcity drives it. High-quality tequila takes years to produce, and aging casks become rarer every year. The wealthy see this not as a novelty, but as an asset class in the making. Gold, on the other hand, is an old story, but one that never gets old. Over the past 50 years, gold has delivered 7 to 8% average annual returns, according to the World Gold Council. It shines brightest in crisis. Inflation, gold rises. Currency devaluation, gold holds. Recession, gold steadies. For the wealthy, gold is insurance, not against poverty, but against unpredictability. In 2025, it's once again the ultimate safe haven, a place where money doesn't just survive, but breathes when the rest of the world panics. Then there's art. Unlike stocks, the value of art isn't driven by earnings or quarterly reports. It's driven by culture, scarcity, and desire. Fine art, especially from established and emerging contemporary artists, offers both personal enjoyment and solid returns. According to the Knight Frank Luxury Investment Index, art remains one of the most resilient asset classes on the planet. The global art market has delivered average annual returns between 5 and 7% for over 2 decades. Wealthy collectors understand something most investors don't. Art doesn't move with the market, it stands apart. When equities fall, art often rises, not because it's more rational, but because it's more human. Taken together, tequila, gold, and art represent the new face of wealth. They're not flashy or algorithmic, they're physical, cultural, and rare, and more importantly, they don't depend on Wall Street. They depend on time, taste, and scarcity. Three things that can't be inflated away. But even as the wealthy diversify into these alternatives, they haven't abandoned traditional markets completely. Higher interest rates, for all their pain, have made bonds interesting again. After years of near-zero returns, yields are climbing, offering steady income for the cautious investor. Selective equities, especially companies with strong fundamentals and pricing power, still offer growth opportunities. But for most high-net-worth individuals, these are no longer the core of their strategy. They're just one piece in a wider, safer puzzle. What's happening isn't just about strategy, it's about psychology. The last few years have broken the illusion of permanence that surrounded wealth. Pandemic shocks, inflation spikes, wars, and AI-driven market volatility all reminded investors that money, no matter how much of it you have, is fragile. For the wealthy, diversification has become more than a buzzword. It's a survival instinct. That's why even within real estate, the focus has shifted. According to Forbes, 74% of wealthy buyers now prioritize proximity to exclusive amenities, private clubs, fine dining, and high-end retail. 70% prefer sustainable, environmentally friendly architecture. Real estate for them is no longer just an investment, it's a lifestyle upgrade, a way to enhance life rather than just multiply assets. They're choosing quality over quantity, meaning fewer sprawling estates and more curated spaces that fit specific lifestyles. At the same time, belief in property as the ultimate wealth builder has softened. Only 21% of high-net-worth individuals now completely agree that diversifying with high-end properties is essential for long-term success, down from 35% last year. The sentiment is shifting from own everything to own the right things. Even the ultra-wealthy are learning that not all assets are equal. The key insight here is that wealth is no longer about what you own, it's about what survives. The rich aren't obsessed with chasing returns, they're obsessed with reducing risk. They've learned that in uncertain times, the most valuable currency isn't money, it's control. Control over what your assets are tied to, control over how exposed you are to debt, markets, and government policy, and most of all, control over time, because time is the one thing even billionaires can't print. The 2025 shift toward alternatives reflects this hunger for control. A cask of tequila ages on its own, regardless of interest rates or stock swings. A gold bar in a vault doesn't depend on a CEO's performance. A painting by a respected artist doesn't care what the S&P 500 does. These assets give the wealthy something they can hold, both literally and psychologically, when everything else feels unstable. But there's a deeper lesson here for everyone else. Because this isn't just about rich people buying expensive toys. It's about how financial power adapts before everyone else notices. The last time the wealthy made a quiet move like this was in the late 1990s, when early investors began shifting toward tech while the rest of the world laughed it off as internet nonsense. Those who caught the wave became legends. Those who didn't were left behind. The same pattern is emerging now, only this time, the focus isn't on software or startups. It's on tangible assets that can't vanish with a market crash or a government policy. In the long run, this transition might redefine what wealth even means. For years, it was measured in numbers on a screen: net worth, market cap, ROI. Now, it's drifting back towards something older, almost ancient. Things of substance, scarcity, and story. Tequila barrels that age into luxury, gold bars that outlast empires, paintings that tell the story of human taste. These aren't just assets. They're reminders that real value exists beyond spreadsheets. Still, this shift comes with trade-offs. Alternatives are harder to liquidate. They require patience, expertise, and sometimes connections. You can't just buy a Picasso on your lunch break. But that's exactly the point. The rich aren't chasing convenience anymore, they're chasing durability. They've learned the hard way that easy money rarely lasts. In many ways, 2025 marks a return to the fundamentals of wealth: scarcity, patience, and ownership. The wealthy are no longer trying to beat the system, they're trying to step outside it. By holding real assets, they're buying independence from financial noise. And in a world driven by algorithms, that might be the smartest investment of all. The irony is that while they're moving away from the traditional system, their decisions will reshape it. As more money flows into alternatives, new markets will rise. Funds will tokenize art, tequila investments will be securitized. Real assets will enter digital spaces. The next decade might blur the line between tangible and virtual wealth, but the motivation behind it will remain the same: protection, control, and preservation. If there's one message hidden inside all this, it's that wealth isn't static. It evolves just like everything else. And the people who see the shift early, the ones who notice when the tide turns, are the ones who end up owning the future. The rich aren't building wealth from nothing because they start poor. They're building it from uncertainty, from the cracks in the old system that everyone else ignores. And maybe that's the real secret. Not just to being rich, but to staying rich. Spot the pattern before it becomes obvious. Adapt before it becomes popular. And move before the rest of the world wakes up. Because by the time everyone else catches on, the real wealth has already moved. Watch the next video and see how the people who understand where the money's moving next always win. And if you're serious about staying ahead of that shift, hit subscribe. You'll want to see what's coming next. Oh, and if you're thinking of starting your own investing journey, take a look at the link in the description. It's the platform I personally use to explore global markets.